I just want to. Hello, everybody, and welcome to Finability's virtual workshop. Today, we're talking about goals and tools. This is part of a 5-part workshop series we designed in partnership with Financial Beginnings, focused on reclaiming your finances and thriving. You can access all 5 workshops on our website at finabilityus.org. I'm Jolene, the Director of Programs at Finability.
And I'm Stan Earnshaw. I am a longtime volunteer for Financial Beginnings and current board member.
Finability is a 501c3 nonprofit with the mission to create financial pathways to safety and joy because we believe every survivor of domestic abuse deserves the opportunity to thrive. We provide the financial tools, mentorship, and support to make that possible. We are an organization by survivors for survivors, and we are founded in response to the reality that 99% of survivors experience financial abuse. Because of that, we know that the information we're sharing today may land differently for each of you. Some folks may feel affirmed or empowered, while others may feel overwhelmed or activated or reminded of painful experiences. All of these reactions are valid, and this is just a reminder to please take care of yourself in whatever ways you need. We wanted to offer some different ways of thinking about goal setting, especially as you might be coming to this information from a harder place. First, start with compassion for yourself and the place that you're in, and know that you deserve financial stability, safety, and a future that you choose. That financial goals are about direction, not perfection, and that you get to define what financial success looks like for you, not anyone else. Also know that healing and rebuilding happen in small and steady steps, and that your strengths and resilience are part of your financial toolkit. Showing up today is already a really powerful step. And when trauma is a part of your picture, it can be helpful to have a trauma-informed mindset shift to help with your goal setting. So maybe you start with what matters most, like safety, security, stability, and peace. Expect ups and downs. Progress after trauma and financial abuse is not linear. And of course, celebrate all forms of progress. Things like clarity and courage and consistency and even trying again. And know that this journey is about reclaiming your agency one step at a time.
As Jolene mentioned, our session today is about setting goals. And when we talk about setting goals, we start with the concept of envisioning your future. By envisioning your future, we suggest dream big. Start with a dream. Take that dream, break it down into goals, and from there, then you can take actions to achieve your goals. Your dream is going to vary by individual. It may be some education, it may be major purchases, it may be something associated with your family, and it may be something starting a business or continuing a business or getting involved in a business. Whatever it is, start with your dream and then you can break it down into individual goals. Goals will help you achieve your dreams. Uh, can be broken down into 3 different categories. Short-term goals are those goals that you want to accomplish in the next 1 to 12 months. Intermediate goals, 1 to 3 years. Long-term goals, greater than 3 years. And as you can see from these examples, you may have a goal that could be intermediate, it could be long-term. In this example, buying a home. Maybe something you want to accomplish in the next 1 to 3 years, or it may be something that's a little further out. Either way, set your goals, put a goal down in each category. Have some short-term goals that may be leading towards your longer-term goals. So if you're looking to buy a home, a short-term goal might be starting to build that down payment fund. Or it may be something that you need today, like a new smartphone, and you're not eligible for a free upgrade, or something you're going to do for yourself. Regardless of what your goals are, if you write them down and if you share them with someone you trust, a form of an accountability partner, your odds on achieving those goals go way up. So start by writing down a goal in the short-term category, writing down a goal in the intermediate term category, and write one down in the long term. Don't worry if you don't have the plan today to put that in place. Get the goal written down, and then you'll start working on the plans. Now, you can establish goals in a variety of categories, but today we're talking about financial goals. And once you've created your goals, the next step is to create a budget. Budgets are one of those things that are difficult to do. Everyone struggles with them a little bit. And budgets are one of those things that you're not going to do exactly right. You're not going to balance your budget to the penny every month. So don't beat yourself up if you don't. Recognize that it's an evolving, changing process. Now, I think we've all seen the formula for creating a budget. It's really pretty straightforward. It's start with your income minus your expenses equals what's left over. Pretty straightforward, right? Ideally, in that expense category, you'll build in some savings, or if you can't, then work towards where you have some money left over, that surplus, where you can save that. But ideally, in your budget, I would plan to have something built in for savings. Let's talk about income. First step, income. Income is going to come from one of three different areas. The first and most common part of income is your earned income. This is what you get from working either at a job where you're an employee or as a contractor, whatever that earned income is. That's probably going to be the majority of your income. Secondly, though, you may have some passive or unearned income. Passive income, one of the best examples is if you have access to a rental property. Having rent come in on a property, that would be considered passive income, and you should build that in as long as you're also building in the expenses for that rental property. And then the third category is portfolio income. This is income you're going to obtain from your investments. And if you may be early in your investment career right now, but recognize there are in particular investment instruments that'll generate income. So start with your income, do the best estimate you can. Okay. One of the questions that gets asked oftentimes is when I'm looking at my earned income, do I use gross pay and then use taxes as an expense? We recommend it's easier if you use your take-home pay. Okay, use your take-home pay as your income and then look at your expenses from there. Now, expenses are put into two buckets. Fixed expenses, these are expenses that don't change month to month, they're the same, and a variable. Variable obviously do. Examples include under fixed expenses, rent, car insurance, loan payments, your phone bill. Those typically are the same month to month. Variable expenses are those that will vary based upon use. So food, you may buy in November, Thanksgiving, you might spend more on food, or in December at Christmas. Clothing could be a variable. Gas, depending on how much you're driving. Taxes. Taxes is a variable because it's based on how much you earn. And entertainment. Entertainment's one of those that can really go up and down. Now, one of the reasons we break expenses into fixed and variable is because when you're looking to balance a budget, variable expenses are easier to control. Fixed expenses will typically have a greater impact on your budget, but variable expenses are easier to control. So it's easier to say, we're going to eat out less next month to minimize our entertainment expense. And so when you're balancing your budget, or if you have some extra expenses in one category and want to cut down on the other, it's generally easier to do that in the variable. Now, when you're looking at cutting expenses, I just mentioned one of these is limit eating out. It's amazing how quickly that can add up. And so if your budget is tight, take a look at that category. In the transportation area, evaluate your insurance costs. And your car insurance may be your second or third highest single line item in your budget. So if you can minimize that or lower that, that's going to help your budget. Two things to do in lowering your insurance costs or to evaluate lowering your insurance costs. The first is combine your policies with one company. Many companies will give you um, a multi-policy discount. And so if you can have your homeowners or renters with the same that you have your car insurance with, that's going to help. The other thing you can do on your insurance is periodically you want to ask for an insurance review. Now, we're assuming that if you go back to our credit module, if you improve your credit score over a year, keep a clean driving record over a year, call up your agent, particularly if you have an independent agent, and ask for an insurance review. That's code speak to the insurance agent that says, I'm evaluating policies. And oftentimes they'll find a way to lower your costs, particularly if you're with an independent agent that has access to multiple insurance companies. Lastly, entertainment, switching from cable to streaming can help quite a bit. Getting an external antenna can help. I know my daughter and son-in-law put an external antenna up and cut cable, and they cut their entertainment expense quite a bit. So these are some tips that you can use for cutting expenses in your budget. What are the things that typically bust a budget or cause someone to go over on their budget? The first is unexpected expenses. Okay, I got a flat tire. I got in a car accident and I have to come up with a deductible. The doctor expense, a variety of things, and we're going to have those. One of the ways you deal with that, and we'll talk about this in a couple of different modules, is create an emergency fund. If you have an emergency fund set aside, that's going to help you deal with unexpected expenses. The other is unrealistic budget line items. If you put in $50 a month for gas for your car, but you're driving every day to work, that's probably an unrealistic budget line item. And so the actual is going to be quite a bit more than the budgeted. Third is making necessary adjustments. You're not going to get it 100% accurate. That's okay. Every month, evaluate your budget and say, where do I need to make adjustments? And one of the easiest habits to get into do that is for a month or two, whenever you purchase something, get a receipt. You know, today we go buy stuff and people say, would you like a receipt? And we all go, no, that's okay. For a month, take the receipt, okay? Then once a week, find a time that you can set aside 30 minutes. Take your receipts and record them into your budget. Now, we'll talk about how you track your budget. There may be some automated ways to do that as well. A budget buster is not following your budget. So if you have set aside $100 a month for eating out, and you've done that through the first 3 weeks, then the fourth week of the month, don't eat out. And then what if scenarios kind of comes along the lines of the unexpected expenses. So these are some tips. These are things that typically bust a budget and ways you might deal with that. Now, the question we often get is, do I really want to do a budget? Well, there are benefits to creating a budget. Financially, it's going to help you achieve your goals. The more you track your expenses, the less you'll spend. Okay? It's going to help you pay off your debt because you're going to build your debt repayment into your budget. And then if you go back to our debt module, you'll see a couple of different strategies where if you come up with some extra cash each month, you use either the debt snowball or the debt avalanche method of payoff and pay off that debt sooner. Having a budget, setting aside money for savings helps you on emergency preparedness. Have the emergency fund set aside. And overall, it'll help you increase your savings. Now, there are also emotional benefits to creating a budget. It's going to reduce stress. You've got a plan. You know what your plan is. You can see your plan. This could help relationships with partners, with offspring, with other family members, because you know what your plan is on what you're going to spend. Particularly if somebody asks you to spend money and you can say, that's not in my budget. It also allows you, when you've got a budgeted line item, to do guilt-free spending. When you look and create budget line item for expenses, notice we had entertainment is one in there, or there may be some other category. This isn't to say you shouldn't spend money on yourself. It's saying you should plan for how much you're going to spend on yourself and when. And once you have a plan, then you have that guilt-free spending, which gives you that sense of empowerment. Lastly, there are physical benefits. You'll sleep better when you have a control over your money and your money's not controlling you, which will improve your overall health, and it helps reduce that decision fatigue. Again, I'm going to buy something. I budgeted for it. I've got a plan for it. I don't have as much worry about should I do this or not. Now, there are tools you can use for your budget. You can use worksheets. You can use a spreadsheet. You can find software. Your financial institution may offer budgeting software, and there are a variety of mobile budgeting apps that you can use. It doesn't matter which one you use as long as it works for you. So the best one to use is one you will use, that you're comfortable using and that you will use. Now, I mentioned financial institution. Let's talk a little bit. As you build that savings, where are you going to keep that money? We have two options, banks and credit unions. They look very similar today. Historically, they were quite different. Today, they look very similar. A few of the differences, a bank is a for-profit entity, and they are maybe privately owned or publicly traded, no membership required. They do pay federal income tax, and they're insured by the FDIC, Federal Deposit Insurance Corporation, up to $250,000. If you're going to put your money with a bank, always make sure that they have FDIC insurance. What this says is if the bank goes out of business, you're going to get your money is safe and protected, up to $250,000 per account. So make sure that whoever you're banking with, and I'm using that as a verb, is FDIC insured. Now, there's also credit unions. Credit unions are not for profit, so they don't pay any taxes. They're owned by the members. Now, membership is easy. It used to be a lot more restrictive. Today, it's very easy. And they are also insured by the NCUA. So again, make sure whoever you are doing business with, bank or credit union, that they have either FDIC or NCUA insurance. And this will be on their website, and if they have a physical location, it'll be on the door that you walk in. They're proud of that. They should be. That's a great protection for you. And you should make sure to do business only with an organization that is either FDIC or NCUA insured. Now, when you're looking to decide who you're going to do business with, look at what matters to you. Do they have the kind of accounts you're looking for? What services do they offer? Do they have a mobile banking app? Can you make deposits through that mobile banking app? Do they have access to things like online payment tools like Zelle, Venmo, or PayPal? Access to your money. Are they conveniently located? If you want a branch to go into, is there a branch nearby? And what network of ATMs might you have access to? Which is important because when you look at fees and policies, ATM fees can really eat into your budget. If you're going to an ATM that's charging $3 to $5 per transaction, and you go there once a week, that can really start to add up over time. And there's no reason to do that because you can find organizations that have networks of ATMs that are no fee. You also want to keep track of your spending and your account balances. You want to make sure you don't write a check, do a transaction that causes you to overdraft or spend more that's in your account because you'll be charged a fee for that. I had an example where my daughter, when she first went to college, overspent, forgot about a check she had written, looked at the balance online, went and bought a coffee, and then when that check hit, the account overdrew, cost her $35 fee. So that coffee, instead of $3, cost her $38. Now, if you have one, go back to your bank or credit union and ask for a fee reversal. If you have overdraft your account, explain this was a one-time event and I'd like a reversal. Occasionally, oftentimes, they will do that. They will give you a reversal. Now, if it's your second or third one in a month or two, they're probably not going to. So keep track of your spending, minimize fees. Fees are just taking money out of your pocket. So when we look at this, what we talk about are some best practices that we encourage all listeners to participate in. We talked about the emergency fund. Everybody should have an emergency fund. You should start with $500. So figure out a way to save up $500 in your emergency fund. And that number is a little magical because that's the typical deductible on a car accident. Once you've built that to $500, grow it to $1,000. That's going to help some of those other unexpected expenses that you may run into this month and prevent you from having to put those unexpected expenses on a credit card. Next, if the company you work for offers a 401k or a 403b, enroll in it. If you put 2 to 3% of your income into a 401k, your take-home pay is going to be about the same because that actually lowers the taxes that you pay. And so putting 2 to 3% of your income into a 401k, you're not going to notice it because your take-home pay is going to be about the same. And your employer's probably matching on that 401k. So if you put $1 in, they're giving you another 50 cents oftentimes, which is an automatic 50% rate of return. So enroll in it. It makes saving automatic. This is your long-term. We'll get into the savings and retirement module about 401ks. You're not going to access that money for some time, but it's an easy way to start saving for retirement. Once you've got your emergency fund, once you've enrolled in your 401k, reduce your debt. Go to our debt module, identify either the snowball or the avalanche method, and start making your minimum payments and then adding any extra you can to get that debt paid off because that's charging you interest. And again, that's money out of your pocket.
So we want to acknowledge that sometimes this information and these topics can sometimes feel overwhelming. So we want to encourage you to really celebrate the small milestones. And of course, this can look different for everyone, but some ways and examples of acknowledging what you've already done might include, recognizing the courage it takes to make any financial decision, especially after experiences where control has been taken away. Honoring the steps you can't see, so asking questions, learning something new, saying no to something that drains you, and celebrating consistency over perfection. So showing up for yourself matters more than getting it right all the time. Acknowledging the emotional wins, so maybe you're feeling more confident or more calm or more clear about what you want and need. And giving yourself credit for rebuilding at your own pace. Again, healing and financial independence happen step by step. Thank you so much for joining us. If you want to learn more about what we do at Finability, our other programs, please visit our website, finability.org. There's also a contact button on our website. If you want to ask questions, give feedback about these workshops, or just learn more, please feel free to reach out anytime. And thank you so much, Stan, for leading us in these workshops. We're really grateful to you and to Financial Beginnings for being such a great partner with us. Thanks, everyone. Have a great rest of your day.